In the last few hours, silver didn't just climb. It snapped. It pushed through the kind of price level that used to feel impossible. And it did it while something even crazier was happening on the other side of the planet. The physical market in Asia started paying a jaw-dropping premium that paper traders in the West can't ignore forever. And that's the real story today. Not maybe someday, not in the long run. Right now, the physical price is threatening to drag the paper price up like a stubborn anchor. And if you've been waiting for the moment where the two markets stop pretending they're the same thing, you might be watching it unfold in real time. So in this video, I want to make sense of what actually happened, why it happened, and what it means if you're holding silver, watching gold, or trying to figure out whether the mining stocks are about to wake up and go absolutely berserk. And yes, we're also going to talk about the weirdest threat to your silver that might be hiding inside your own home right now. It's funny until it isn't. We'll get to that in a bit. Now, quick but important. I'm running a campaign to push back against copycat channels that steal the work and dilute the message. If you value what I do here, hit subscribe and comment OG John AG so I can see who's really riding with me. And one more thing before we dive into the numbers. If you want daily updates, quick posts, and my personal analysis that I don't put on YouTube, plus instant voice notes when something breaks, I made a WhatsApp channel for this community. The link is in the description. Join it because those updates move fast. Alright, let's start where the stress is highest because the market always tells the truth where the pain is. Overnight, the story wasn't just silver is up. The story was that the physical price in Shanghai surged to a record level. And the gap versus the so-called spot price in the United States blew out into the kind of premium that makes you sit up and blink twice. Think about what that means. It means buyers over there weren't negotiating. They weren't waiting. They weren't saying, let me see if it pulls back. They were bidding for real metal right now. And they were willing to pay a massive markup to get it. And when that happens, it's not a chart pattern. It's not a vibe, it's stress. Because if the paper market truly represented supply and demand, a premium like that wouldn't exist for long. Arbitrage would close it, metal would flow, prices would equalize. That's the textbook world. But we're not in the textbook world. We're in a world where the East is bidding for physical, and the West has been leaning on the price with paper for so long that the physical market is starting to act like it's in a different universe. And I want you to keep that in mind as we go through everything else, because this is the thread that ties the whole story together. Now let's zoom out for 1 second and get our emotions under control. I know it feels wild to even say this out loud, but the spot price of silver is hovering around the $90 area. And here's the part that should rewire your brain. About a year ago, silver was sitting under 30. That's not a rumor. That's not exaggeration. That's the kind of move that can make smart people do dumb things because big moves trigger big emotions. So I'm going to say something that might be the most valuable sentence in this entire video. Don't let emotions steer the decisions you make today. Ever. I'm not telling you what to buy or sell. I'm not your financial advisor. I'm telling you that the fastest way to ruin a great position is to get high on green candles or to panic the first time you see a red one because volatility is the price of admission. And with silver, it's not a gentle roller coaster. It's a rocket with turbulence. Now, while we're on that topic, I want to throw a question at you. And I want you to answer it in the comments because it tells me a lot about where your head is at. Do you believe silver pauses at $100 or do you think it blows straight through and shocks everyone? Drop your answer below. I read the comments and it helps the community learn where the crowd is leaning. Alright, let's go back to the core mystery. If silver is ripping higher in the West and physical premiums are exploding in the East, why does it still feel like most of the world is asleep? A major silver whale, one of those people who holds more metal than most of us will see in a lifetime, basically summed it up like this. Silver can be moving violently and still only a tiny fraction of people have any clue what's going on. And I agree with that because you can walk into a room of 100 people and maybe one of them has ever thought seriously about the monetary system. Maybe one has asked what happens when debt piles up and trust breaks down. And maybe one understands why hard assets have been a lifeboat for thousands of years. Wild. Now let's talk about the first big driver, the physical decoupling. A few weeks ago, a lot of people were warning that we could reach a point where the spot quote on a screen stops behaving like the real price you pay for metal. And what we're watching now looks a lot like the early stages of that. Because if you have a huge premium in a major physical hub, what it really says is this. The metal is not where it's supposed to be and the supply chain cannot instantly fix it. And that's when paper promises start to look fragile. Now that alone is powerful, but it gets even crazier when you look at what's happening inside the Western paper market. On a single recent trading day, the volume of silver traded in paper form was measured in the hundreds of millions of ounces. Let that sink in. In one day, the paper market can churn an amount of silver that rivals an entire year of global mining output. And we're supposed to pretend that's normal price discovery? We're supposed to pretend that's just liquidity? Come on. If you've ever wondered why silver can feel like it's being held down, or why it can move in ways that don't match reality, this is your answer. A paper market that big can create the illusion of supply even when physical supply is tight. It can create fake calm even when the vault is sweating. And the moment the physical market forces the paper market to reconcile with reality, you get moves that look like this. Now, in the middle of all of this, something happened that most people will gloss over. But I want you to pay attention because it's one of those quiet signals that tells you the system is strained. The US Mint moved to suspend or pause sales of certain collectible products while pricing is being evaluated. And translation, when the input cost is moving so fast and demand is so hot, they don't want to sell a product at a price that becomes outdated before the invoice is even printed. That's not a conspiracy. That's operational stress. It's the kind of message you see when markets stop behaving politely. A premium that large is the market screaming that the screen price is not the same as the delivery price. It's the difference between saying you own something and actually having it in your hand. And if you've never lived through a moment like that, it can be hard to grasp why it matters. Now, this is also why you can see a strange pattern where the paper price moves higher begrudgingly, not joyfully. You'll see rallies that look choppy. You'll see sudden drops that feel like someone slammed the price with a hammer. And then you'll see the price creep back up like it's being pulled by a magnet. That kind of behavior is exactly what you'd expect when there's a tug-of-war between paper liquidity and physical scarcity. And if you noticed weird intraday action recently, sharp dips, quick recoveries, those jagged sawtooth moves, don't ignore it. That's what stress looks like. It's not smooth because the system is trying to balance two realities at once. Now, speaking of big fish, there was a moment recently where a major trading desk that was positioned against silver got forced to cover as price ran through key levels. You don't need the name to understand the point. When you short something, you're borrowing a promise. And if price moves against you fast enough, your broker doesn't care about your opinions. Your broker cares about risk. So they force the position to close, which means buying into strength. And when forced buying hits an already tight market, it can turn a rally into a vertical move. That's why people call it face ripping. Because the market doesn't just beat you, it humiliates you. Now let's add another layer, the institutional narrative shift. You can feel it if you pay attention. For years, mainstream commentary treated precious metals like a relic. They'd talk about them like a hobby. They'd say, why hold metal when you can hold financial products? But lately, major banks and large asset managers have been floating ideas that were unthinkable not long ago, like meaningful allocations to precious metals as part of modern portfolio construction. Not 1%, not 2%. They're talking about allocations that are large enough to matter. And even if only a fraction of big money follows through, the flows can be enormous compared to the size of the physical market. That's why I keep coming back to scale. In precious metals, small changes in allocation can create huge price consequences. Now, let's go back to that paper volume point because it deserves a sharper explanation. When nearly 1 billion ounces of silver trades in a day on paper, what that really means is the market is trading claims, not bars. It's like trading receipts. And in normal times, receipts can work. But receipts only work when everyone trusts that if they show up, the warehouse can deliver. The minute people suspect the receipts exceed the inventory, the game changes. That's when you start hearing words like delivery stress, backwardation, cash settlement, and all the other polite phrases people use to describe a simple reality. There isn't enough to go around at the old price. Now, I'm not saying the system collapses tomorrow. I'm saying the system becomes more fragile the longer it leans on paper, and fragility is what creates outsized moves. Now, I want to keep this practical. So let's talk about what you can actually do with this information. First, if you hold physical, you need to know where it is, how it's stored, and who has access. Yes, I'm serious. Because the threat in your home joke is funny, but it also points to a real issue. People don't plan. They stack, they get excited, and then they leave the plan fuzzy. So decide now. Is your stack a family asset? Is it your personal hedge? Is it earmarked for a specific goal? Have that conversation before the price goes even crazier because nothing creates sudden interest like a headline and a number on a screen. Second, if you're thinking about mining stocks, don't treat them like metal. They're not metal. They're businesses. They have management teams, costs, political risks, dilution risks, and financing risks. So if you're going to play that game, stay disciplined. Third, if you're just watching and learning, don't let the speed of the move make you feel hopeless. Big moves can be intimidating, but markets don't move in one candle forever. They breathe. They shake people out. They offer new entries at different times. Your job is to stay educated, not to chase emotionally. Now here's the next cliffhanger I want to set up, because it's the question that decides whether this is a sprint or a secular shift. What happens when the retail crowd shows up? Because right now, a lot of demand is institutional, regional, and informed. But retail demand has a different personality. It's messy, it's impulsive, it's driven by headlines and fear of missing out. And when retail demand collides with limited inventory, you don't get calm price action. You get discontinuities, you get gaps. You get, sorry, we're out of stock signs. So the key is to watch not just price, but availability. If you start hearing consistent reports of empty shelves, long delays, and shrinking selection, that tells you the market is moving from pricing to rationing. And rationing is where things get dramatic. Now there's one more reason those huge gold numbers matter for silver. Because if gold reprices, the gold to silver ratio becomes the battleground. If the ratio compresses, silver can run harder. If the ratio stays wide, gold can lead. Either way, the metals complex stays in focus. And that's what matters for miners, for hedgers, and for anyone trying to protect purchasing power. Now let's bring this home with the most important point. This is not just about tomorrow. It's about the kind of world we're moving into. A world where currency creation is normalized. A world where debt is rolled and inflated away. A world where supply chains are politicized. A world where resources become strategic. In that world, hard assets stop being alternative and start being necessary. And that shift doesn't reverse easily. It becomes part of how people think. It becomes part of how institutions allocate. And once that happens, you get a long runway. Now, before we go further, let me slip in a creative quick note, because some of you ask me for this all the time. If you're into silver-related success stories, real people, real wins, and the mindset behind how they did it, there's a link in the description to a separate channel dedicated to that. Check it out and subscribe over there too, because those stories can keep your motivation high when markets get noisy. Alright, back to the main story. Everyone is talking about $100 silver like it's some magical ceiling, and you're hearing the same narrative on loop. We'll hit 100, then we'll pull back. Maybe, maybe not. Here's what I've learned after watching markets for a long time. The thing everyone expects is rarely the thing that happens cleanly. Sometimes the market pauses right at the round number just to humble the crowd, and other times it blasts through the round number just to embarrass the crowd. So instead of worshipping a number, I want you to focus on the forces, because forces beat feelings. And the forces right now include physical premiums, ongoing demand, and a paper structure that looks increasingly fragile. That's why some analysts are saying the move could go higher, faster, and more aggressively than the public expects. And that's also why short positions, especially the late confidence shorts, can get trapped, because when a crowded trade breaks, it doesn't break politely. It snaps. Now, let's talk about that threat in your home, because we all need a breath. There's a meme going around the metals community that basically says this. When silver was cheap, your spouse looked at your stack and thought you were insane. Then when it runs, suddenly the stack becomes our stack. And when it goes parabolic, it becomes my stack. So yes, joking aside, your biggest threat to your silver might not be a bank. It might not be a hedge fund. It might be the person upstairs who suddenly discovers a deep emotional attachment to those shiny rounds. Laugh now, but you better have a plan later. And speaking of plans, here's another question I want you to answer in the comments, because it helps everyone. If the gold to silver ratio drops hard, would you swap some silver for gold, or are you riding silver all the way? Tell me your strategy below. No shame either way. The goal is clarity. Now let's move into gold for a moment, because silver's story is explosive, but gold's story is the foundation under the whole building. A major global investment firm recently ran a thought experiment that made a lot of people's jaws hit the floor. They asked a simple question. If gold were required to back modern money supply the way it did under older monetary systems, what price would gold need to be? And the numbers they came up with weren't small. If gold were backing base money, the estimate implied tens of thousands of dollars per ounce. If gold were backing broader money, the estimate implied numbers that sound ridiculous to a normal person until you remember how much currency has been created over the last few decades. Now, I'm not saying gold is guaranteed to hit those numbers tomorrow. I'm saying this, those calculations show you the scale of the imbalance between paper claims and hard collateral. And once you understand that scale, you understand why precious metals don't need hype to win. They just need time. Now, with that said, let's talk about the miners because this is where a lot of people feel confused. They look at silver near $90 and they look at certain silver mining stocks and they say, why aren't these things already flying? And it's a fair question because mining stocks are leverage plays. When the commodity price rises, profits can expand faster than the price itself, assuming costs don't rise at the same pace. Here's a simple way to visualize it. If a miner produces silver at $20 an ounce and silver sells at $30, the margin is $10. If costs stay around $20 and silver sells at $60, the margin is $40. The price doubled, but the margin quadrupled. That's the magic and the danger of leverage. So why do miners sometimes lag? Because markets don't move in straight lines. Because investors wait for confirmation. Because big funds rotate slowly. And because people who miss the move in physical metal sometimes hesitate before chasing equities. But here's the key point. When the earnings report starts showing what these companies are generating in cash flow, it forces attention. It pulls in capital. And once capital starts flowing, miners can move like they're strapped to a rocket. Now, I'm not promising you that every mining stock will win. Some are managed poorly. Some are diluted to death. Some are in risky jurisdictions. That's real. But as a sector, when metals run, miners can go from ignored to adored in a hurry. And I want you to remember something else. One major difference between gold miners and silver miners is that the gold miner benchmark has already pushed beyond prior major peaks, while the silver miner benchmark in many cases is still below its old highs. That creates a tension because when silver itself challenges key levels again and again, the stocks can suddenly catch a bid and the people who have been fading them can get steamrolled. Now let's get to the part that ties everything together. The macro forces that don't care about your opinions. First, China. There's growing chatter that China has turned on the stimulus spigot again in a big way, injecting enormous liquidity into the system. Whether you call it QE, stimulus, or something else, the result is the same. More currency, more credit, more demand chasing real assets. And the numbers being discussed for China's money supply are massive. So massive that in US dollar terms, their broad money measure is often described as far larger than the United States. Now here's the part that matters for metals. If a country expands money supply aggressively, while also prioritizing real assets, it can create sustained demand pressure. And if that demand pressure shows up in physical hubs, it doesn't stay isolated forever. It leaks into global prices. Second, the West. There are estimates floating around that a handful of major Western financial institutions have accumulated enormous short exposure to silver through paper derivatives. Whether the exact number is perfectly precise isn't the point right now. The point is that if short exposure is massive relative to available physical supply and physical demand tightens, it creates a risk, and that risk has a name: squeeze. Now, a squeeze doesn't happen because people wish for it on social media. A squeeze happens because obligations meet constraints. It happens when paper sellers need to buy back and the physical market refuses to cooperate. And if that's even partially true, it explains the violence of the move you're seeing now. Now, the third macro force is geopolitical. And this is where the decades narrative starts to make sense. Look around the world. Conflict zones, trade wars, energy politics, resource nationalism, alliances shifting, supply chains being reorganized. The world is not becoming more stable. And when the world becomes less stable, countries and institutions tend to prefer reserves that don't depend on someone else's promise. That's the oldest story in finance. And that's why gold matters. And that's why silver, as an industrial metal with monetary history, can become a pressure point. Now, the fourth macro force is debt. Global debt levels are at a scale that makes prior eras look small. And when debt grows faster than productive capacity, the typical solution becomes currency creation, financial repression, and policies that quietly transfer purchasing power away from savers. That's not a political statement. That's a mechanical one. And this is where I want to bring it back to you, the viewer, because it's easy to get lost in the big picture and forget the practical reality. If you're holding metals, your biggest challenge isn't knowing the thesis. Your biggest challenge is managing your behavior because the market will test you. It will spike and make you euphoric. Then it will dip and make you doubt yourself. And the people who win are usually the ones who stay strategic. Now, while we're building this community, I want to ask something directly, and I want you to take it seriously. If you've had success, any kind of success in your life, whether it's business, investing, career, or even just discipline and consistency, share one lesson in the comments. It sounds simple, but it's powerful. Your story might be the exact thing someone else needs to hear to keep going. Now, let's talk timing because everyone wants a calendar. People keep asking, is this the top? Is this the move? Is it over? And the honest answer is nobody knows the exact path. But we can observe signals. We can observe that physical premiums suggest immediate tightness. We can observe that paper volume suggests structural distortion. We can observe that institutional attention is growing. And we can observe that money creation is not stopping globally. So the real question isn't, will silver go up forever without a pullback? The real question is, what kind of pullbacks are normal inside a secular repricing? Because in a repricing, pullbacks are opportunities for some and traps for others. Now I want to do something that mainstream headlines never do. I want to zoom out and be honest about risk. Yes, metals can pull back. Yes, they can be volatile. Yes, mining stocks can be even more volatile. But the reason people hold them isn't because they think every week will be green. They hold them because they don't trust that paper promises will preserve purchasing power over long time frames. They hold them because they want an asset that is not somebody else's liability. Now, let me address something that I know is happening right now behind the scenes. My YouTube statistics show that a huge chunk of people watching these videos are not subscribed. And I'm not mad at you. Maybe you've been busy. Maybe you forgot. Maybe you're still deciding if I'm worth it. But if you want to support this work, do it right now. Subscribe and drop OG John AG in the comments so I know you're part of the core. And remember, the members only video will already be live by the time you're watching this. If you want one single video where I lay out the updates and go deeper than I can here, join the membership. That's where I share more in-depth analysis for people who are truly following the journey. Alright, now let's revisit the action on the chart because there's a psychological trap here. When silver runs from under $30 to around $90 in a year, the brain starts doing two dangerous things. One, it starts assuming the next move must be down because nothing goes up forever. Two, it starts dreaming about infinite upside because look at what it just did. Both of those extremes can hurt you. The healthier mindset is this: understand the thesis, understand your time frame, and understand your plan. If you don't have a plan, the market will write one for you, and you won't like it. Now let's walk through what's actually happening in a clean way. We have physical stress in major hubs. We have the paper market still attempting to frame the price. We have institutions and wealthy buyers paying attention. We have calculations from serious firms that highlight just how small gold is relative to the scale of modern money. We have miners that can deliver explosive earnings leverage if metals prices hold anywhere near these levels. And we have macro forces, China liquidity, Western derivatives, geopolitical instability, and debt that create long-duration tailwinds. So when someone asks, why could this continue for years? The answer is because the drivers are structural, not seasonal. Now let's talk about the $100 and pullback narrative again because it's important. If everyone expects a pause at $100, that becomes a crowded expectation. And in markets, crowded expectations are fragile. Sometimes you get the pause. Sometimes you get a violent fake out where it spikes above then wicks down just to shake out weak hands. And sometimes you get what nobody believes. A clean blast through with follow through because the physical market is forcing repricing. So don't marry a number, marry your process. Now I want to give you a practical framework for thinking about what's next without pretending I can predict the future. Watch three things. First, keep watching physical premiums in major buying regions. If they stay elevated, it means demand is still urgent. Second, watch how paper selling behaves on up days. If the price keeps grinding higher, even with heavy paper volume, that tells you the physical pull is overpowering the paper push. Third, watch the miners versus the metal. If the miners finally start catching up, it can be a signal that broader capital is rotating into the sector. Now, let's address a common strategy question that people ask when prices move like this. Should I swap some silver for gold if the ratio compresses? That can be a rational approach. If silver outperforms massively, it may make sense for some people to convert a portion into gold to rebalance. The point isn't that one metal is better forever. The point is that ratios matter and you can use them as a discipline tool instead of an emotion tool. But again, this is personal. Your needs, your risk tolerance, your timeline. Those things matter. Now before we wrap, I want to underline a theme that keeps coming up in this community. We are still early. Not early in price maybe, but early in public awareness. Because when the public really wakes up, the buying pressure changes character. It becomes chaotic, it becomes frantic, it becomes the kind of rush where the average person walks into a shop and sees empty shelves. And by the time that happens, the calm accumulation phase is gone. Now I'm not saying that to create fear. I'm saying it because it's the historical pattern. When trust breaks, hard assets get scarce. And silver in particular is a smaller market than most people understand. That's why it can move fast. Now let's take one more breath and bring it back to the human side. The reason we build a community here is because markets can make you feel isolated. You can feel like you're the only one paying attention. You can feel like you're crazy when the world tells you everything is fine. And then you watch silver move like this and you realize, no, you weren't crazy, you were early. And being early isn't comfortable. It's only obvious in hindsight. Now I want you to do something for me. If this video helped you, if it clarified the story, or if it gave you a calmer framework, hit the like button. It matters more than people think because it helps the algorithm put this in front of the next person who needs to hear it. Then subscribe if you haven't. Join the WhatsApp channel for daily updates. And if you want the deeper cut, join the membership and watch the members-only video that's already live. And finally, I want to leave you with a challenge that keeps the comment section strong. Share one success lesson and answer this. Are you expecting a controlled climb from here or a violent breakout that shocks the market?